Thanks, Denny, and welcome back to Investing with Confidence. I am your host, Joshua David. If you're just tuning in, Al was shedding some light on what's happening with investors in different stocks, how the news is impacting things, how the public reacts to that, but more so, how we can make better decisions based off of facts, and that's based off of supply and demand, which is facts on a price chart. If you happen to miss 2 tickets for the investing class, call 952 814 4410. You can also register for this investing class by going online to learnwithota.com. Also, if you have questions during the live stream on YouTube, type them in. We'll try to answer them during the show. So, Al, as I promised in the last segment, I want to talk a lot about 401ks and IRAs, basically
Hmm.
qualified retirement plans, which is essentially your life savings, your
Right.
savings for life. And that's what people are doing in all of their working years from when they start working, hopefully when they start working, up until they retire. But it's important to continue that investment strategy during retirement as well. So let's dissect a little bit the difference of 401ks and IRAs. So let's start with the 401k, or what are company
Hmm.
sponsored plans and what do you have access to?
Right. We talk about 401ks. When we talk about them, we're really talking about all of the employer sponsored retirement plans. It might be 401k, 403b, TSP, whatever it is. Those are employer sponsored retirement plans, which are pretty much sold to you as this great vehicle that's going to have you living a fantastic retirement. And what they'll do is they'll say, here are a number of investments you can invest in. You choose. Uh, Typically, they're mutual funds, maybe some exchange traded funds now with some 401ks, maybe stock. But typically, the go to are mutual funds. So your plan sponsor says, here's the list, go to it. Now, you make the choices as to which ones you're going to invest in. And unfortunately, what most people do is put it on cruise control. Every 2 weeks or every month or however often you get paid, a portion of your paycheck is taken out before taxes and is put into this plan to whatever the investments are that you have chosen. And then hopefully you have an employer that will also contribute something. And, to be honest with you, look at the returns of 401ks. A good portion of it, if not in many cases, the majority of the growth or that number that you see comes from your contributions and your employer's contributions. The growth of the actual investments themselves are pretty mediocre because you have mediocre choices, plus you're paying fees. And those fees are taking money out of your account on a regular basis, enough so that over the course of your working years, maybe 40 to 60% of what you could have in your retirement account is gone. So putting it on cruise control, number one, is going to have you just holding on to something for a long period of time, not worrying about these big drawdowns and corrections. Here's an example: if you put 100,000, or you had $100,000 in your retirement account in the year 2000, by the year 2009, March of 2009, 9 years later, your 100,000, if you had investments that actually kept up with the S&P 500, which most of you don't have, but if you did, your 100,000 would now be worth a whopping $43,000.
Wish I had some cheering on this thing here today.
Yeah, there's no applause on that. That's a lot of money. If you had $1 million account, now you're down to $430,000. That's what happens if you put something on cruise control and you don't take advantage of some of the assets and the strategies that you can utilize without putting a lot of time into it. That's not our goal for you. But you can have a strategy or an asset that will protect your assets. It's like an insurance policy. So if the portfolio goes down in value, that asset will go up in value. You can trade within your 401ks. It doesn't mean that you have to just put money into one thing and then hold on to it for 30 or 40 years. You can use a price chart. And this is really the key is knowing how to read a price chart for anything, for stock, for a mutual fund, for an option, a future, a Forex contract. They all have charts that you can read that will tell you a story about that particular asset. Everything you need to know is there. Well, if you have mutual funds or ETFs in your 401k, you can read the price chart, identify when it might be moving into an area where there are a lot of sellers. Maybe you want to roll out of that one into something that is moving into an area where there are buyers. Or there's nothing wrong if we are going through a market correction or crash, maybe rotating into a fixed income or a cash equivalent choice that you probably have in your 401k. So that's kind of the 401k example.
Yeah, well, Al, I know you want to get into IRAs as well, but the problem is, I think a lot of people, we're trained from our beginning of our working years is put a bunch, put money into our 401k and just put your head in the sand.
Right.
Let it just, hopefully it'll go up. And they always say, well, hopefully you get enough to retire. Well, the fact of the matter is people don't have enough to retire. So they're just doing things. And what that one word is, or that two word is, getting by.
Yep.
And people don't want to just get by. A lot of the cause is the fees. That's why it's so important to understand what can you do with your 401k? How do you make better decisions in there yourself? But you got to learn how to do that. There's tools that our sponsor Online Trading Academy has to potentially help you do that, but do that with more confidence. So if you want to learn more about those tools with 401ks, Al teaches investing classes here at the Academy. So I want to give away some tickets to this investing class. We do them during the week. We also do them on Saturdays as well. Callers 1 through 10, call 952-814-4410. That's 952-814-4410. When you call in right now, you receive the Financial Quick Start Kit as well. So let's talk about the other qualified retirement
Sure.
plan, which is IRAs.
Mhm.
There's a couple different types. You have Roth and you have traditional. So what is the difference between them? And then let's talk about what may be the best to use based on your age as well.
Yeah, the difference is there's two big differences. One is with a traditional IRA, all of the contributions go in pre-tax, so you're not paying any tax on that, but you will pay tax on everything that comes out. With a Roth IRA, the contribution is after tax, but everything, the investment money you put in and all the growth of it comes out tax-free when you take the money out. That's a huge difference. And really, you want the big number to be the growth part, not the part that you put in. And with an IRA, whether it's a traditional or a Roth IRA, the advantage you have over a traditional employer-sponsored retirement plan is, number one, you're not paying those fees. The fees that are draining money out of those accounts, which results in negative compounding. So every dollar that could be in those accounts, creating additional dollars, which create additional dollars, which create additional dollars, that's gone. That really ends up being a negative to you. In the IRAs, the Roth IRAs, the traditional IRAs, you eliminate those fees. You have assets that you can trade that will benefit you potentially in a down market, not just an up market. Most of you, almost all of you in your employer-sponsored plans will only benefit if the market goes up. You only have the potential to benefit then. In your traditional or Roth IRA, you can participate in down markets. There are assets that are great to use when the market is sideways, when it's not going anywhere. And here's the three things that are really important when you go into retirement. Number one is protect what you have. How are you protected right now? How are your assets protected? What will happen to your retirement accounts if we go through a major market correction? What if we go through a 20% or 30% drawdown, or like we did in the year 2008 and the year 2000, down over 50%? How much of an impact would that have on your portfolio? Well, you don't have to have that happen. There are assets that can protect your portfolio. What about the fact that when you retire, the one thing that you have used primarily to pay all your bills is gone? That's your income. How are you going to replace that? How are you going to be able to pay the bills that you have coming in without just continuously drawing down your retirement accounts? We teach assets that you can use and strategies that you can use to do that, to take care of those bills. Then what about growing your portfolio? Because a lot of people want to leave a legacy. Maybe you've got kids or grandkids or some charitable organization. So instead of drawing down your retirement portfolio to the point where maybe it's gone and you still have years left, why not grow that? So you're kind of replacing the income part with some strategies. You're growing those assets and you have protection. All of those are available to you. And those are the things that we talk about in the classes that Josh has been talking about.
Yeah, so basically what you're saying then is because the people can take once you're 59 and a half, you can draw it out of a retirement account without
a penalty,
right?
Mm-hmm.
So do you think it makes sense? So say someone is listening and they're over 59 and a half. Do you think it's best for them to trade in a Roth IRA themselves? That way there's no tax on the capital gains?
Yeah, I would say, it's each individual may be a little different, but for most people, if you can have a Roth IRA, check with your tax people to make sure that you qualify. If you can have a Roth IRA, That's a great vehicle because if you're using some of the strategies and the assets that we teach that have leverage, which we haven't even talked about yet, but that gives you a multiple impact of the value of every dollar that you're investing. If you can do that, you can have the growth part of that portfolio, be substantially more than the investment part that you put in. If all of it comes out tax free, that's a huge benefit to you. Because a lot of us, when we retire, we're going to be at we may be in a higher tax bracket than we're in now. Do we have any debt out there? Does this country have any debt?
Maybe a couple trillion, maybe one or
Yeah, no, that's
two.
almost per day. I mean,
Yeah, exactly.
the debt grows significantly, and somehow that's got to have to be paid back. Already there's talk of actually promises of higher taxes. So you can't count on being in a lower tax bracket. That's where the real advantage in a Roth is that you don't have to worry because it's all tax free.
Yeah, it's just making better decisions when you're preparing for that, that retirement is doing things properly with your life savings, but then continuing that into retirement. That way you can make better decisions. So especially with Al's talking about with up and down markets, there's different assets that you can utilize in an IRA. Whether it's traditional or a Roth. And we talk about a lot of those different assets that allow leverage, as Al is talking about. Essentially, you get more bang for your buck with leverage. So if you want to learn more about those leveraged assets, he teaches investing classes here in Bloomington. And let's do this. Callers 1 through 10. I'm going to give away two things here. You're going to receive 2 tickets, actually 3. You're going to receive the Financial Quick Start Kit or the Retirement Planner. So callers 1 through 10, call in right now and make sure to mention one of those 2 things, the Financial Quick Start Kit or the Retirement Planner. That will help you get started right away. 952-814-4410. That's 952-814-4410. Now, coming up next, I want to talk a little bit more. We've mentioned leverage. I want to talk a little bit more about that, how to utilize or get the most efficiency out of the capital that you do have, but also self-directing is probably the best way to do that. 952-814-4410. This is Josh and Al, Investing with Confidence. We will be right back.